Hey traders, welcome back to another episode of Trade Like Assad. Today, we're finally unveiling one of our premium trading frameworks, the whale scoop model. This high-level strategy could completely transform the way you engage with the markets. It's a powerful method that may significantly boost your win percentage. In this session, we're moving past the theory and diving straight into the whale scoop model, step by step. We'll break down the essential points and all the concepts you need to grasp in order to master this advanced approach to trading. All we ask is that you watch the full video without skipping, it's crucial. We truly value your continued support, so don't forget to like the video and subscribe to our channel if you're new here. Catch you right after the intro. Welcome back traders, so let's get started. We have simplified everything you need to know about this strategy to get the most out of it. Watch the entire video without skipping any parts. The whale scoop model has the potential to become your cornerstone trading strategy, helping you become a consistently profitable trader. In this episode, we will cover the core mindset behind the whale scoop model, the exact candlestick patterns involved, the specific entry models, the appropriate time frames for executing trades, the various forms of the whale scoop, real chart examples to solidify your understanding. Now let's start with Part 1, the mindset behind the whale scoop model. The key to grasping the whale scoop model lies in understanding that it revolves around a liquidity sweep and stop hunt of major static liquidity levels. This includes significant highs and lows, prominent supply and demand zones, and similar critical areas. This strategy is focused on executing trades at these external range liquidity zones, either by buying or selling there, and then targeting the opposing side's external liquidity for exits. Take this scenario. Here we have a market low. When using the whale scoop model, if the price drives below a pivotal structure, like a swing low, it triggers a sweep of the sell side liquidity. The model suggests entering a long position at this point and holding until the price reaches the buy side liquidity on the opposite end. The most important concept in this model is that after the price clears a static liquidity pool, it often reacts with a sharp move in the opposite direction. At the heart of the whale scoop strategy is a simple premise. When one side's liquidity is removed via a sweep, the market tends to shift towards the remaining liquidity, often aligning with the prevailing trend. This liquidity event frequently sparks a change in market sentiment, causing traders to pivot and seek trades on the side where liquidity is still untouched. The whale scoop takes full advantage of this dynamic, leveraging the reaction between these liquidity zones to identify setups with strong risk to reward potential. So, why is the whale scoop considered a high-probability trade setup? In this context, we classify the pattern as a high-probability setup because the liquidity beneath the recent low has already been taken out. This implies that numerous stop-loss orders have been activated, creating a surge in buy-side pressure and driving bullish momentum. Due to this sharp shift, traders are left with minimal time and few opportunities to place entries in that zone or reposition their stop-losses below the lowest point of the latest whale scoop. There's an absence of any significant pending order clusters, suggesting that the market has no real incentive to move lower from this level. Moreover, with price action beginning to push higher with notable momentum, it indicates a clear bullish sentiment. This movement reinforces the belief among traders that the retracement phase has concluded, and the asset is likely to resume its primary upward trend. This conviction draws more participants into the market, initiating long positions to capitalize on the anticipated continuation. The result is a rapid build-up of buying volume over a short span. These dynamics form the foundation of why the whale scoop model is considered a solid and statistically favorable strategy, especially when executed with precision. Now, let's move on to the next section and explore how to spot a valid whale scoop using candlestick analysis. As previously discussed, the foundation of the whale scoop model is based on identifying legitimate liquidity sweep formations on the chart. That's why one of the most essential, and also most difficult, parts of this method is correctly spotting a valid whale scoop pattern in live price action. A proper whale scoop typically involves a sequence of candlesticks. This might appear as a single large candle or a combination of several that clears a key level, such as swing highs, swing lows, or important supply and demand zones. After this liquidity grab, the price swiftly returns within the range of the targeted key level and kicks off a significant and sharp market reversal. You'll often see a long wick, especially on higher time frames, when a whale scoop occurs. In most cases, this structure forms across multiple candles. A crucial detail to validate the setup: no subsequent candle's body or wick should break above or below the body or wick of the initial sweep candle. Let's consider this example. Price sweeps through a previous key level with a pronounced wick, then immediately closes back below the range, confirming a valid whale scoop formation. However, whale scoops don't always appear this clean or textbook-like in real-time trading conditions. As you begin analyzing charts for these setups, you'll likely run into various patterns that might raise doubts about whether they truly qualify. To clear up any confusion and build a solid grasp of how this works, let's go ahead and break down multiple candlestick whale scoop examples in the next segment. Starting with example 1, we observe a classic whale scoop formation occurring across 2 consecutive candles. The initial candle kicks off the liquidity sweep by breaching the highest point of a significant swing high, closing decisively above that level with strong upward momentum. Immediately after, the next candle drops back into the key area's range, signaling a potential reversal. It's important to highlight that this is the only type of whale scoop that may indicate price manipulation, leading to a directional shift. Typically, a close above a major high suggests continuation, not reversal, but in this setup, we see something different. In this case, the price grabs buy-side liquidity with a sharp wick above the key zone, then pulls back and closes under it. Price then dips slightly higher before falling, completing the setup. This is a textbook example of a valid whale scoop, confirmed by the fact that none of the following candles break the wick or high of the initial sweep candle. Moving to example 2, we again witness a perfect 2-candle whale scoop. The first candle's wick clears liquidity over the previous level, followed by a third example that closes back within the range, leading to a swift downside move. This showcases the power and precision of the whale scoop model, delivering high-quality entries with excellent risk-to-reward potential, evident in the large red bearish candle that follows. In the final example, the price again clears liquidity above a known zone, then returns within the penetration candle's range. But instead of dropping instantly, price consolidates for a bit inside that range before continuing lower. Despite the pause, this scenario also qualifies as a valid whale scoop, since the core conditions are met. Now that we've covered multiple candlestick variations of the whale scoop, let's move forward and break down the entry techniques you can apply with this strategy. There are 2 primary entry approaches when executing trades using the whale scoop method: the aggressive entry and the conservative entry techniques. The aggressive entry in the context of smart money concepts or ICT methodology is somewhat like placing a limit order at a higher time frame supply or demand zone. However, with the whale scoop, the approach slightly differs. This method involves operating entirely on a single time frame, used both for identifying the setup and executing the trade. Once you've spotted a valid whale scoop pattern, you remain on that same time frame to place your trade. Here's the step-by-step. After recognizing a legitimate whale scoop setup, wait for the market to print an engulfing candle. This candle must engulf the previous candles involved in the scoop structure. Once that candle forms, your entry is placed at its close. For stop-loss placement, you have 2 options. One is to set it a few pips beyond the penetration candle of the whale scoop. Alternatively, for a tighter setup and better risk-to-reward ratio, you can place the stop-loss a few pips beyond the engulfing candle itself. As for the take-profit target, you'll aim for the nearest external liquidity zones visible on the chart. Since this entry method works off higher time frames, trades are generally not held for long durations. The most effective time frames for this strategy include the 30-minute, 1-hour, 2-hour, and 4-hour charts. These are the only suitable intervals for applying the aggressive entry model effectively. Now, let's examine an advanced whale scoop formation that makes use of this aggressive entry approach. As you dive deeper into chart analysis, this specific setup stands out as one of the most high-probability trading opportunities to keep on your radar. In this example, supply zones dominate the structure, and the price action has clearly established a bearish trend. After the initial downward move, price retraced back into the most recent supply area, which acted as an inducement zone. This pullback triggered the stop losses of early sellers who had shorted from that level. From there, price pushed higher, tapping into a second, unmitigated supply zone, effectively mitigating the order block present in that region. It then surged upward once more, sweeping the liquidity resting above the order block. What's happening here is key. The lowest unmitigated supply zone served as the trap, or inducement, activating the stop losses of short sellers. Meanwhile, more traders were likely drawn into new short positions from the upper order block, unaware that they were contributing to a growing liquidity pool just above the second supply zone. This behavior pulls the market upward into that liquidity pocket, giving smart money the fuel it needs to execute a whale scoop, clearing liquidity above the supply, tapping into the fair value gap, and then reversing direction with strong bearish continuation to the downside. One of the most crucial elements of this setup is that price must whale scoop the liquidity accumulated above or below key supply or demand zones, fill the nearby fair value gap, FVG, and then quickly re-enter the supply or demand range, ideally within just a few candles. We're looking for an immediate and clean liquidity sweep that's aligned with fair value mitigation. Now, if you're wondering about the psychology behind this setup, here's the key insight. When a liquidity sweep occurs alongside fair value gap mitigation, it signals that the market has cleared out most of the buy-side liquidity, whether that's stop-loss clusters or liquidity voids from unfilled imbalances. Once that's done, there's nothing left to grab on the buy side, meaning the market is free to dive towards sell-side liquidity, continuing in alignment with the dominant trend. To trade this high-probability pattern effectively, we first need to identify a clean whale scoop, backed by the necessary confluences, liquidity sweep plus FVG mitigation. Once confirmed, we wait for the formation of an engulfing candle that confirms momentum. At its close, we execute our sell order, placing the stop-loss just beyond the whale scoop's penetration candle or engulfing candle, whichever gives better risk management. This is the exact type of setup I always watch for. It offers precision, strong narrative, and clear intent from smart money. And yes, the same logic applies to bullish setups, just in reverse. Now, let's break down the conservative entry model and how it fits within the whale scoop strategy. In the conservative entry method of the whale scoop strategy, we utilize two distinct time frames, a higher time frame for market analysis and a lower time frame for entry confirmation and order execution. To apply this method effectively, we first identify a valid whale scoop pattern on the higher time frame. Once confirmed, we then shift to a lower time frame to wait for precise entry signals and structure shifts before placing our trade. The next step involves switching to a lower time frame to closely observe price action and patiently wait for a confirmed change of character, CHO-CH, pattern. Once this market structure shift is identified, we set our entry at the 61.8% Fibonacci retracement level of the CHO-CH wave. The stop loss should be placed a few pips below the lowest point of the whale scoop. For take profit, TP, you can target the nearest external liquidity on the entry time frame. If you're aiming for a higher risk to reward, R ratio, you can place your TP at a key level from the higher time frame. Alternatively, entries can also be set at a lower time frame demand zone, order block, created by the CHO-CH wave or at fair value gaps, FVGs, formed during the rally following the structure shift. However, my preferred method is to enter at the 61.8% Fibonacci level drawn from the CHO-CH wave. Before diving into live chart examples to demonstrate trade execution using the whale scoop model, let's briefly review the appropriate time frames for this strategy. Personally, I prefer using the 1-hour time frame for market analysis. This is where I identify valid whale scoop patterns. Once a setup is confirmed, I shift to the 5-minute time frame for precise trade execution. However, your time frame selection can be tailored to your trading style. For example, you might opt for a 15-minute chart for analysis and drop down to the 1-minute chart for entries. Alternatively, you could use the 4-hour and 15-minute combination. For higher time frames, the principle still holds. If your whale scoop forms on the daily chart, your entry should be on the 1-hour chart. If it's identified on the monthly chart, drop to the daily chart for execution. The core principle is simple. Your analysis time frame should always be at least 2x higher than your entry time frame. Additionally, there are specific times in the trading day when the whale scoop setup is more likely to succeed. These optimal time zones will be covered in upcoming episodes of the whale scoop trading model. Now that we've broken down the foundational concepts, let's dive into real trade examples to see the whale scoop strategy in action. On the screen, we're analyzing the EUR/USD pair on the 1-hour time frame. The market is clearly in a downtrend, consistently forming a series of breaks of structure, BOSS, to the downside. Starting from the top, price broke below a key structure level with evident inefficiency, establishing an unmitigated supply zone at the extreme. After a brief consolidation, the bearish momentum resumed, leading to 2 consecutive breaks of structure and the formation of 2 new unmitigated supply zones. Eventually, the market began to lose bearish steam, as price paused again and formed buy-side liquidity beneath recent swing lows. From there, price retraced and tapped into the most recent unmitigated order block, only to break above it, triggering the stop losses of early short sellers. However, the move was short-lived. Price quickly reversed and closed back below the zone with an engulfing candle, likely reinforcing bearish sentiment. Many traders took this as a signal to enter fresh short positions, placing their stop losses just above the supply zone. The logic was that the price had swept buy-side liquidity, respected the supply, and closed with bearish intent, suggesting a continuation towards sell-side liquidity below the swing points. But instead, the market executed a classic trap-retrap, TRTR, on sellers. Price used the first unmitigated supply zone to induce short positions twice, hunting stop losses both times. After that, it pushed higher, targeting the second unmitigated supply zone, again using the lower zone as a liquidity inducement. Once at the second zone, more traders entered shorts, but again, the price didn't respect the supply zone. Instead, it broke above it, triggering even more stop losses and sweeping liquidity, ultimately forming a valid whale scoop pattern. Notably, the price filled the only fair value gap above the order block before re-entering the supply range. This rapid liquidity sweep followed by FVG mitigation is a textbook example of a high-probability whale scoop setup. This chart presents a strong confluence of key conditions: liquidity inducement, stop loss hunts, twice, FVG fill, immediate re-entry into supply, all of which confirms a powerful whale scoop scenario, just as discussed in the previous section of this trading model. In the next phase, it's time to execute a sell order and enter the market. For this setup, I'm applying the aggressive entry method of the whale scoop model, placing my entry at the close of the bearish engulfing candle, which forms just beneath the supply zone. My stop loss is set a few pips above the highest wick of the recent upper candles, effectively securing the trade against any unexpected spikes. For the take profit, I'm targeting the sell side liquidity positioned below the recent swing low. Since this is an aggressive entry executed on the 1-hour time frame, we prefer to avoid holding positions for too long, capitalizing instead on the immediate momentum. Now, let's play out the trade. As you can see, the price continued to drop with strong bearish momentum, eventually reaching the take profit level cleanly. This trade serves as a textbook example of the whale scoop model in action, precisely the kind of setup I look for when entering the market. Let's now move on to the next trade scenario to deepen our understanding of the model. On the chart, we're observing the EUR-USD pair on the 1-hour time frame. As evident, the market is in a clear downtrend, consistently forming multiple break of structure points to the downside, signaling strong bearish momentum. If we zoom into the 15-minute time frame, we can see that price aggressively swept the liquidity above the previous high with a sharp wick. Immediately after, it reversed and closed below the high's range, forming a valid whale scoop pattern on the 15-minute chart. Now that we've confirmed a valid setup, the next step is to execute a sell order. For this, I'll be applying the conservative entry model of the whale scoop strategy. To proceed, I'll switch to the 1-minute time frame and patiently wait for the price to form a clear change of character, CHO-CH, as confirmation before placing the trade. Now we're looking at the 1-minute time frame chart. As shown, the price formed a clear change of character, breaking and closing below the key structure, confirming a shift in market direction. This movement also left behind a noticeable inefficiency, signaling strong bearish intent. Next, we proceed to execute a sell order. I'm placing a sell limit at the 0.618 Fibonacci retracement level of the change of character wave. To manage risk effectively, the stop loss is set just a few pips above the most recent swing high, keeping it tight and controlled. For the take profit target, I've chosen the nearest swing low, as I expect the price to move in that direction based on current momentum and market structure. Now that our sell limit order is placed, let's monitor the trade. As the price action unfolds, we can see the market triggers our order and begins to push downward, aligning well with our expectations and the whale scoop conservative entry strategy. Eventually, the price reaches our predefined take-profit target, delivering a favorable reward-to-risk ratio and confirming the success of this trade setup. Now, let's move on and analyze another example. Once again, we are analyzing the EUR-USD pair on the 15-minute time frame. Upon closer inspection, we can observe that the price swept the liquidity above a key structure, marked notably by a single red candle, which was immediately followed by a sharp rejection and a downward move. The price then re-entered the range below the previous high, confirming the formation of a valid whale scoop pattern. With this pattern now identified, we'll zoom into the 1-minute time frame for a more detailed view of the price action, specifically to look for a change of character (CHO-CH) pattern to validate our entry setup. Now shifting our focus to the 1-minute time frame, we can observe that the price has formed a clear change of character by breaking and closing below a key structure, leaving behind a noticeable inefficiency in the process. With all the conditions aligning perfectly, the next step is to execute a sell order. I'll be placing a sell limit order at the 0.618 Fibonacci retracement level derived from the change of character move. This method provides an optimized entry point with a tighter stop loss, improving our overall risk-to-reward ratio. Unlike placing an order solely on the order block, which might miss ideal entry opportunities, this approach increases precision and reduces potential losses. For risk management, I'll set the stop loss a few pips above the highest point of the whale scoop pattern. The take-profit target is aligned with the recent swing low, a significant level where we anticipate price to react. Now that the sell limit order is placed, let's observe how the market responds. As shown, the price did push lower once our order was triggered, eventually hitting the take-profit target. That concludes this trade example. Thank you for watching, traders. I hope you found this video informative and valuable. If you did, make sure to hit that subscribe button and turn on notifications so you never miss an update from us. Your feedback matters. Drop your thoughts and suggestions in the comments below and let us know what trading topics or strategies you'd like us to dive into next. Thanks for your continued support, and we'll catch you in the next episode of the Whale Scoop series. Trade smart, stay sharp.